So let's say you invest in an ETF that invests in different companies in the tech sector. You have immediate diversification in tech stocks, which you don't have when you invest in individual companies. Or you have an index fund that invests in the companies that are in the S&P 500. You have that immediate diversification. Another benefit is that index fund, mutual fund, even ETF investing is a passive way of investing. When you have to analyze stocks, you're actively doing the research, analyzing these companies. But investing in a fund, it's a more passive way of investing because you have a bunch of money that you just put into your brokerage account, and at the right time, you just put money into buying that ETF, index fund, mutual fund, etc. Another benefit of investing in a fund is that the research has already been done for you. And the research is also still being done by the fund manager to make sure that the correct companies are in that fund that you're investing in. This makes it extremely easy because all you have to do is make sure that you're investing in the correct fund. Now, in order to get that confidence to know that you're investing in the correct fund, you need to look at the track record and the history of how that fund has performed. That will give you the confidence to make sure that that fund will perform well into the future. Now, the future is always unpredictable, of course, anything can happen, but looking at the history and also looking at the fund manager's performance, how long has the fund manager been in the business, how many different funds is he or she managing, that will all give you the confidence to make sure that, yes, this is the fund that I want to invest in. So some of the disadvantages of investing in a fund is that you're pretty much taking your hard-earned money and you're giving it to a fund manager and you're telling the fund manager, here, go ahead, take my money and invest it. And for that privilege, you will pay the fund manager a fee, of course. Some investors don't like that. They still like to be hands-off with their investing in individual companies, day trading, swing trading, etc. Another disadvantage of investing in a fund is that you might not pay attention to what you're actually investing in. So there is a list of companies that you will be invested in, but you might not see that full list up front. If you are morally against specific businesses or business practices, let's say you don't like weapon sales or you don't like for-profit prison systems or you're against CBD, you want to make sure that the fund that you're investing in is not invested in those companies. Nowadays with technology, it's pretty easy to get a full list of the companies in a specific fund because all you have to do is go to the company's website, get a full list of the companies in the fund, or you can even request it from the website. You could also go to the SEC website and put in the ticker symbol of the fund and get a list of all the companies in that specific fund. But that's something that you definitely need to pay attention to. If there are some things that you're against, make sure that you're not investing in those types of companies. Even when I look at my investing strategy, I love investing in individual companies. I like doing the research and putting them in my watch list, and I have a watch list of over 50 companies that I keep an eye on, and I buy them whenever they're selling at a discount, whenever the value is there, preferably dividend paying companies. But I also have different funds that I invest in, different ETFs, different index funds. And it makes my portfolio balanced because there's instant diversification when I invest in the ETFs and index funds. But then I also have the individual where I'm making some passive income through my dividend paying stocks.